Today, in this section, we're going to be looking at the manufacturing accounts. And in looking at the manufacturing accounts, we will want to so we'll be looking at definition, aims. We'll look at meaning of production. We'll look at costs elements. Then we'll do format before summary. So we would want to carefully run through the definition of the manufacturing accounts. We'll look at the aims, we'll look at the meaning of production or manufacturing. We'll look at cost elements, format, and then we summarize. So manufacturing account is that account that is prepared by the manufacturing outfit to determine or calculate the cost of production. So the whole essence of going through the process is that there are certain companies or businesses that produce what they sell. Others are just into buying and selling. But certain other companies produce what they sell. And for those companies that produce what they sell, we call them the manufacturing outfit. And that's why we say the account they prepare is called the manufacturing account. And the aim of the manufacturing account is to determine the cost of production. It is also targeted at determining what is known as the gross profit on manufacturing. The concept of gross profit on manufacturing can only be introduced when there is a market value, when the goods produced are transferred from the factory to the marketing department at a market value. We are going to dwell on that mostly when we get to take an illustration, comprehensive illustration, and that will be in our next video. So there are two major things you need to figure out in course of preparing the manufacturing account, which of course I have said is to determine the cost of production and possible manufacturing gross profit on production, which is emanating from the fact that goods from the factory will be transferred to the marketing department on a market value. So we will talk about the meaning of production. Having successfully defined the manufacturing account, having stated clearly the aims of preparing the manufacturing account, it is important we talk about the meaning of production or manufacturing. Actually, every single activity targeted at converting or transforming raw materials into finished goods is known as production or manufacturing. And this is not unconnected with factory cost. Every time you go into the factory for production, you incur some cost, which is the whole essence of preparing the manufacturing account. So all effort targeted at converting or transforming raw materials into finished goods is known as production or manufacturing. That will take us to the cost associated to these factory activities that will translate into production or manufacturing. So you talk about cost elements. Cost element is the structure of the cost that is incurred in the factory. And with the help of a simple diagram, we are going to look at the cost elements with the help of a simple diagram. Of course, this is cost of production. Cost of production. And majorly, or basically, this cost of production is divided into two major parts. First part is what is known as prime cost. And the second part is what is known as overhead. The prime cost is further divided into 3. And the overhead is divided into 2. For prime cost, you have what you call the direct material, which I like to abbreviate as DM. And you have the direct labor, which I like to abbreviate as the DL. And you have the direct expenses, which is DE. For overhead, you have factory overhead, and you have non-factory overhead. So it means that production cost is a combination of prime cost and overhead. But most importantly, for the calculation, for the essence of calculating cost of production, for overhead, we are going to restrict ourselves to what we call the factory overhead, leaving this non-factory overhead for a next section where we'll be talking about the conventional trading profit and loss account, having determined the cost of production. We will not, when we talk about the P&L, that's when we will treat what is known as non-factory overhead. Meanwhile, prime costs are those costs that are directly traceable to units of production. That is to say that for prime costs, every 1 naira you put in have a direct bearing on the outcome, which is the number of units that we produce. They are directly traceable to the number of units that will be produced. And we have said that they are divided into 3 basic components, which is known as the direct material, direct labor, and direct expenses. For factory overhead, which is our area of concentration as long as overhead is concerned in cost of calculating the cost of production, we are going to give you examples, simple examples, when we go into the format of factory overhead. But factory overhead or overhead generally are those costs or expenses incurred in the factory that cannot be directly traceable to the units produced in the factory. That is to say, whether you incur this cost or you don't incur this cost, it will have nothing to do with the units produced in the factory. So it's important to note that these cost elements are categorized based on their direct influence or traceability to the unit produced. So going down, you need to know that no examiner will give you direct material as a figure. No examiner will do that. It requires you to go into some calculation for you to be able to determine the direct cost of direct material. And by the time you add it to direct labor, add it to direct expenses, you add it to your factory overhead, you have cost of production. I'm going to leave all the other explanations as regards to this cost element to when we go into the format. So ladies and gentlemen, with your kind permission, let me wipe off this part of the board to be able to put up a comprehensive format to further explain the manufacturing account. So we're going to look at a format Okay, let's take our Naira sign, which is our reporting currency. Of course, you know it's important to always state your reporting currency, which in this case is Naira sign. So we're going to start our computation towards the determination of cost of production from direct material. So first and foremost, I will put material. And then, of course, with your basic knowledge of the conventional trading profit and loss account, you should be able to understand this computation easily. So we have opening stock of raw material. Anytime I say R/M, I mean raw material. And then, so you add purchase. The purchase you add is going to be purchase of raw material. Of course, you know, purchase don't always come alone. It comes with each of its own elements, which might be carriage inwards or purchase return. So you're going to add carriage inwards to purchase to figure out your net purchase. So we have carriage inwards, and then you less return outwards. Now, the outcome of this addition and subtraction will be net purchase. Net purchases. And then when you finally take purchase and add to opening stock, purchase of raw material, add to opening stock of raw material, what you have is what we call cost of raw material available for use. Now, this is a computation that you need to master because, like I said before, no examiner is going to give you a direct value for materials or direct materials. They expect you to use your basic knowledge from the conventional trading profit and loss account to compute for direct material. So at this stage, you're going to less closing stock of raw material, which will give you cost of raw material use. So at this point, you add your direct labor or wages. You add your direct expenses. And then what you have then is what we now refer to our prime costs. Okay, but it's important to note, when we say direct labor, what does it mean? Direct labor is talking about the wages, the amount of money paid on a daily basis to those factory workers. And when you talk about direct expenses, you're talking about the amount of money probably spent on the hiring of equipment used in the factory. Those are examples of direct labor and direct expenses. So at this point in time, we're going to add our factory overhead to be able to come up with our gross cost of production. Please let me, with your kind permission, wipe this other side of the board to continue with that format. So I'm going to continue with this format with the 2 naira sign, which is our reporting currency. So you're going to take factory overhead. And under this factory overhead, of course, there are lots and lots of these items of expenditure that are incurred in the factory but does not have any direct bearing on the units of the product that to be produced. They are called factory overhead. So I'm going to add them to our prime cost to be able to get our cost of production. So first, let me start from depreciation on plant and machinery. Of course, depreciation on plant and machinery is because plant and machinery are used in the factory, so their depreciation cost will be treated in the cost of determining the cost of production. We can also take factory fuel. We can take factory rent and rates. Let me add here that this is not the main account, it's just a format. But whenever you talk about these expenses that show themselves under the factory overhead, examiners might not just give you figures and say, okay, factory rent and rate is 5,000. In most cases, they will give you a lump sum and expect you to appropriate that lump sum between the factory and admin. Because, of course, when you talk about rent and rate, of course, some will go to factory, some will go to the admin offices, and then the examiner will expect you to use a certain percentage to divide these lump sums for these items of expenditure among the factory or the admin. So this is just a format. When we take a full-blown illustration, we will be able to explain to you by virtue of the question what the examiner will expect you to do just to guide you properly. So we can take, having taken rent and rate, we can take supervisors, factory supervisors, factory supervisors' wages. We can take lubricants. They continue like that on and on. But we are going to stop here so that we can be able to accommodate a concept that I think is important to know about. That concept is known as work in progress, WIP. Now, in the factory, most times they start work on some products, and then before the end of the trading or manufacturing section, they will not have been able to finish the work, production work on that product. So it stopped halfway. That you stop halfway, it does not mean that you will not compute it, value it, and put it into your computation for cost of production. If you don't do that, it means you'll be neglecting the cost of the WIP. So work in progress means those products that production have started on them, but they are not yet finished. Products that are halfway, yet to be concluded, they are called work in progress or WIP. When you have the concept of WIP in a manufacturing account setting, you need to add, of course, if you take all of this, put together and add it to your prime cost, you have a value called gross production cost. So you take opening cost of WIP and less closing stock of WIP. So when you less this, you take the net of WIP down here and then add it to your gross. You have net production costs. Now, at this point in time, ladies and gentlemen, I'd like you to pay great attention because I'm going to introduce a concept that is not mostly taught in most of the secondary schools, as long as my years of experience have shown. But it's a very friendly concept with the examiner. And so the examiner, of course, most times, is not interested in what you have been taught or not, but is interested in what you had supposed to have known. And that concept is known as the unrealized profits. Unrealized profit cannot come into the concept of cost of production without the introduction of what is known as market value. Market value means that everything that has been produced, okay, let's suppose that this net production cost is, if the net production cost is 1.5 million, the manufacturing department can decide to transfer the net production cost of everything produced to the marketing department at a cost of 10% of cost of production. That 10% is called a profit margin. So anytime you carry the profit margin and add to the net production cost, what you get is what is known as the market value. And the implication of that is that it will create a manufacturing gross profit, which would double your gross profit in the conventional profit and loss account. That will be further expatiated upon when we get to by the next section, when we take a comprehensive illustration. So this is net production cost. At this point in time, if the examiner had said, take 10% of the cost of production as profit margin, you're going to have what we call manufacturing gross profit. And by the time you add your manufacturing gross profit to your net production cost, you're going to have what is known as market value. You will be wondering, why would somebody waste all of this time in trying to compute cost of production? It is because every account, be it for non-profit making organization, be it for those organizations that are into buying and selling of their own product, every organization must prepare an account that is known as the final account. The final account is a set of accounts prepared at the end of a trading period to determine the gross profit, the net profit, and the financial position of a business. And so conventionally, when you take the trading profit and loss account, you see that you take cost of sales. Traditionally, you take cost of sales and you begin to less, you take sales revenue and begin to less cost of sale. At that point in time, you will need purchase. For those organizations that are into buying and selling, you will need purchase. But for the manufacturing outfit, you will need to take the production cost and replace it with the purchase, because they are not buying what they sell. They rather produce what they sell. And so you take the value of cost of production, or what is known as market value, if you are to transfer the goods produced to the marketing department at a profit margin. So you take market value and replace it with your conventional net purchase in the trading profit and loss account. At this point in time, I like to advise that you subscribe to our channel to be able to be part of the next section, because that's where we're taking a comprehensive illustration, and that's where we will be able to explain all of these concepts using practical figures to be able to impact on you and also create a positive impact as long as your exam is concerned. At this point in time, I like to pause and let you know that in summary, the part of factory overhead that we were not able to treat here because it is not relevant for the computation of the cost of production will be taken to the conventional trading profit and loss account, where we will treat it at either administrative cost, as either selling and distribution, as the case of financial charge, as the case may be. At this point in time, I like to pause and take some questions from the app. Let's actually compare what we have done so far to what is in the mind of the examiner. Let's look at some questions from the ExamGuide app. Of course, you know, is the most leading #1 app as long as you want to pass your exam at one sitting. ExamGuide is the best of friends. And if you don't have it as an app in your phone or in any of your gadgets, I believe that you're missing a lot. Let's take some questions. Okay, #1. Question number one said administrative, selling, and distribution expenses in a manufacturing firm are recorded in A, trading account, B, manufacturing account, C, profit and loss account, and D, balance sheet. Of course, you remember in course of our discussion, I told you that factory overhead is divided into factory overhead and non-factory overhead. And so non-factory overhead includes what we call the administrative, selling and distribution expenses or financial charge. So what we have here is administrative, selling and distribution expenses. And the examiner is expecting you to answer where are they recorded in the manufacturing firm. Of course, because they are non-factory overhead, they are recorded in the P&L. They can't be in the trading account because trading account takes sales and sales revenue and cost of sales. And administrative, selling and distribution overhead are not part of the cost of sales. They are not part of the factory overhead. They are non-factory overhead, which of course is recorded. The correct answer is C. Option is C, because it is recorded in the profit and loss, conventional profit and loss account.